Crypto Pirates Daily News, July 6, 2021. Latest news headlines. 5 technology trends that will continue to exist long after the pandemic. As interest in Ethereum 2.0 soars, over 6 million ETH have been staked. Following a cyberattack on hundreds of businesses, hackers have demanded $70 million in Bitcoin. What are the 4 most significant differences between digital currency and cryptocurrency? Japan is anticipating greater clarity regarding the digital yen next year. Will the Bitcoin crash entice more investors to switch to traditional retail investing? The Central Bank of Vietnam is investigating CBDC. Five technology trends that will continue to exist long after the pandemic. Connor Galway of Junction Consulting outlines several digital advancements that organizations and brands should be aware of. Whenever a new technology is discovered, people will flock to it, but it will never be a substitute for efficient business communication. Does this sound familiar? That phrase isn't about Snapchat or Zoom conversations, it's about the skepticism that has surrounded breakthroughs in business technology since the birth of the telephone. At the time, business leaders were anxious that phones would intrude on the real manner of doing business, which included handshakes, golf courses, and smoky boardrooms. Merrill Lynch Wealth Management declared that it has effectively banned phone calls as a method of reaching out to new clients. Instead, the digital marketing department is encouraging young traders to utilize LinkedIn and follow up on inbound leads generated by the department. If you've seen Boiler Room or The Wolf of Wall Street, you're aware of how important the basic telephone has been in the growth of the financial services industry. Now, those same companies are abandoning the technique that was once responsible for so much of their success in favor of a digital-first strategy. This realization may seem 5 to 10 years late to many of us, but as someone who spent the early 2010s attempting to convince business leaders that websites were here to stay, it serves as a reminder of how far we've gone in a decade. It's easy to look at an outmoded industry and marvel smugly how they didn't see the inevitable shift and the impact it will have on their businesses. However, many of us are probably in the same boat. We are currently witnessing the greatest transformation in consumer behavior in a generation. Because of the pandemic, we were all obliged to do almost everything digitally, which resulted in online fitness classes, delivery everything, and a never-ending stream of Zoom calls. Lockdowns, and our reactions to them, are only transitory. The question is, what will endure? This summer, every company will ask itself what it needs to let go and which technology will help it succeed in 2021 and beyond, much like Wall Street traders who may never again pick up the phones that founded their businesses. Each industry will have its unique chances, so as a starting point, we've compiled a list of 5 current technology trends. I recommend compiling your own list of changes that will have an influence on your industry. Work from any place. Even before the pandemic, the phenomenon increased by 173% in the United States from 2005 to 2018. Companies such as Airbnb and WeWork are building the infrastructure, and studies are emerging that show individuals may be more productive away from the workplace. There will be enormous potential for products and services that assist nomadic workers, as well as benefits for businesses that develop methods to allow and equip remote workers. Cryptocurrency payments. Apple Pay, MasterCard, and Square are on board. Roughly 20% of millennials own coins, and 47% seek out retailers who accept some type of cryptocurrency payment. Cryptocurrency has the potential to replace the hole left by cash payments in a few years. Augmented reality. It is already being used in Google Maps and Snapchat. The next stop is glasses, of which Snapchat has recently unveiled a new version. AR has arrived gradually, and it will soon be ubiquitous. Apart from blurring the barriers between physical and digital shopping, it will encourage organizations to approach each touchpoint as part of a single customer journey. Remote insourcing. Employees all throughout the world are doing work that was formerly done by agencies and contractors. We recognize during the epidemic that we are no longer confined to the talent in our communities, thus an increasing number of businesses are widening their searches for employees regionally, if not globally. The opportunity to hire great creative professionals on a flexible basis has sparked a trend in which brands are building their own teams to handle work that would normally be outsourced to a third party. The brands that embrace that global viewpoint, as well as the agencies that can leverage it, will be the victors. Sell online, experience offline. Retailers are educating and entertaining customers in their stores in order to increase e-commerce purchases. That is the polar opposite of how retailers have traditionally viewed their online and offline connections. When everything can be purchased in 2 clicks and delivered within 24 hours, individuals must have a compelling reason to leave their homes. However, if we can get consumers to interact with our businesses in person, we've just won a genuine opportunity to make a lasting impact. The only question is whether our physical experiences are up to the task. As interest in Ethereum 2.0 soars, over 6 million ETH have been staked. Exuberance over the imminent Ethereum upgrade has resulted in the stake of 6.1 million Ether on the Ethereum 2.0 network, valuing the staked coins at $13.6 billion as of Monday, according to Etherscan data. This represents a greater than tenfold increase in value when Ethereum developers launched the Ethereum 2.0 beacon in 2020. A total of 190,946 deposits have been made to the ETH 2.0 contract address. According to JP Morgan, this enthusiasm is likely to propel not only the Ethereum 2.0 network, but also the entire crypto staking sector, which might reach $40 billion by 2025 as a result of the growth of staking value in Ethereum. Ethereum is transitioning from a proof-of-work to a proof-of-stake mining algorithm, which means that those interested in mining will need to invest in the network in order to earn additional coins by confirming transactions. Ethereum 2.0, on the other hand, is a collection of interrelated upgrades, the most of which are currently in progress and being worked on by developers. To obtain staking rewards, one must stake a minimum of 32 Ether by confirming network transactions and protecting the network, which can be accomplished by operating a staking node on their machine or via a VPS. This way, a user can receive around 5% APR on any ETH placed on the network, with the overall payout per user dependent on the amount staked on the platform. In comparison to proof-of-work mining, proof-of-stake mining does not require users to waste as much energy. This makes it more energy efficient, as it will use less computer power and energy to manufacture new coins than it currently does. Additionally, the upgrading to Ethereum 2.0 will aid in improving the network's speed, efficiency, and scalability. For example, after fully upgrading to Ethereum 2.0, the network will be capable of processing hundreds of transactions per second, allowing it to be employed in more complex and cost-effective applications. They will, however, be required to continue using the same proof-of-work mechanism until around early 2022. We hope you enjoyed watching and listening to this video. Please let us know your opinion in the comments area below. If you found our content useful, please like it and share it with your friends. Also, don't forget to subscribe to our channel and hit the notification bell for more crypto-related contents. Following a cyberattack on hundreds of businesses, hackers have demanded $70 million in Bitcoin. In a stunning recent revelation, a group of hackers has admitted to orchestrating a large ransomware attack over the 4th of July weekend. REvil, or Ransomware Evil, is the hacker gang that operates in Russian. On Friday, the organization launched an attack on over 200 US businesses and firms. Additionally, it targeted a number of other companies worldwide, including Swedish supermarkets, affecting over 1 million machines. This is one of the most widespread and sophisticated cyberattacks in history. The cost of erasing encrypted data from these hundreds of businesses is prohibitively expensive. On the REvil blog, the hacker group demanded a ransom of $70 million in Bitcoin. Even though no company has acknowledged the precise amount of loss, this ransom demand is too large for the companies to fathom. REvil requested a ransom in exchange for decrypting the organization's files publicly within an hour. The group targeted businesses that use Cassia's services, which provides information technology solutions to over 40,000 businesses worldwide. Cassia's CEO responded as follows. Cassia has performed admirably. We are awaiting a comprehensive report on this incident once it is addressed. We are extremely lucky that this occurred on the 4th of July weekend, when the majority of our consumers are off work. If this had been a typical work week, the calamity would have been far worse. The FBI and CISA have been working cooperatively with Cassia's management to locate cyberattack victims. According to reports, businesses and corporations will require a pretty high degree of technological and cybersecurity skills and services in order to avoid becoming victims of these cyberattacks. Concerns and suspicions have been raised that REvil's attacks are connected to the Russian government. However, no official judgment has been issued in this case. According to US Vice President Biden, officials are uncertain about the Russian government's involvement in this strike. REvil previously targeted the world's largest meat packer, JBS SA, forcing them to pay a Bitcoin ransom of almost $11 million. These Bitcoins were traced back to a Russian-language marketplace. As a result, the allegations leveled against Russia are amplified. This time, the cyberattack is significantly more intricate and pervasive. Additionally, the attack's influence on the volatile cryptocurrency market, particularly Bitcoin, remains unknown. We hope you enjoyed watching and listening to this video. Please let us know your opinion in the comments area below. If you found our content useful, please like it and share it with your friends. Also, don't forget to subscribe to our channel and hit the notification bell for more crypto-related contents. What are the 4 most significant differences between digital currency and cryptocurrency? Everything is shifting online in today's fast-paced technological environment. Not only established firms, but also innovative ones, are impacted by digital solutions. When cryptocurrencies gained popularity, some individuals inquired about the distinctions between digital currency and cryptocurrency. Indeed, they are both ephemeral and exist solely on the interwebs. Despite certain similarities in their digital footprints, there are numerous elements that significantly distinguish the two. What does the term digital currency mean in comparison to the term cryptocurrency? Here is your unequivocal response in crypto-ticker fashion. 1. Security and cybersecurity. The primary distinction between digital currencies and cryptocurrencies is the technology that underpins both. While many digital currencies are unencrypted, cryptocurrencies are by definition encrypted. Digital currency users rely on the infrastructure maintained by the company's servers. On the other hand, cryptocurrencies are based on their own blockchain, which is highly secure by design. 2. Stock price. When discussing cryptocurrencies, the question of their volatility is frequently brought up. Their costs fluctuate constantly due to supply and demand. On the other side, digital currencies are typically less volatile and are sometimes even tied to a certain traditional currency. That is why investors prefer cryptocurrencies over digital currencies. These individuals seek capital gains, which are defined as changes in the price of the underlying asset. 3. Availability of information and transparency. When it comes to digital currencies, consumers may not have complete information, such as the total number of transactions conducted on a given day or the sender or receiver of each transaction. They frequently contain minimal information on the transaction, such as the date and time of the transaction, the amount, and the mode of payment. Everything is transparent for cryptocurrency holders. They obtain secure and confidential access to all pertinent data. 4. Infrastructure. A critical distinction between digital currencies and cryptocurrencies is the infrastructure upon which both operate. While digital currencies are managed by a centralized firm or institution, cryptocurrencies are by their very nature decentralized. This allows those firms complete control over how those digital currencies are managed, maintained, and altered. Any misfortunes incurred by the businesses are borne by digital currency users. Cryptocurrencies, on the other hand, are based on a decentralized infrastructure that is completely independent of third parties. We hope you enjoyed watching and listening to this video. Please let us know your opinion in the comments area below. If you found our content useful, please like it and share it with your friends. Also, don't forget to subscribe to our channel and hit the notification bell for more crypto-related contents. Japan is anticipating greater clarity regarding the digital yen next year. Hideki Murai, leader of the ruling Liberal Democratic Party's cryptocurrency committee, has declared that fresh improvements to Japan's central bank digital currency, CBDC, will occur next year, not this year. Significant characteristics of the digital yen require clarification. The top party spokesperson revealed that the Bank of Japan, BOJ, has not yet resolved critical aspects of the digital yen. A feature of this type is the definition of entities that would act as a link between depositors and the central bank. Murai recently told Reuters in an interactive session that the design of our CBDC will have taken shape by the end of next year. He added that the Apex Bank has not yet decided whether to issue a digital yen when the CBDC's second phase of testing begins. This second phase is expected to commence in the coming year. However, Murai noted that there may be a further debate concerning the digital yen's influence on banks and other financial organizations when additional information become available. Even prior to the release of the CBDC, Japan's financial system is undergoing significant transformation, as a growing number of non-finance enterprises provide online settlement services. The only way to avoid banks being swept away in this evolution is for the BOJ to make it necessary for commercial banks to be involved in the design and distribution of the digital yen. Additionally, the official stated that a CBDC issued by the BOJ would have a significant impact on our country's financial and settlement institutions. There is a likelihood that the CBDC may reverse the current financial landscape shift in our country. Japanese yen versus Chinese yuan. Murai also stated that the BOJ's digital yen must be consistent with the CBDCs of other governments in order to be superior to China's digital yuan. When the digital yuan is more widely utilized in trade settlements and by tourists, there will be a huge disparity between the yen and yuan. He warns that if this occurs, the yen's status as a safe haven currency will be utterly undermined. The BOJ made the original announcement of a CBDC development last October. However, the BOJ stated that it has no immediate plans to issue the CBDC. 3 months ago, the bank conducted a trial of the CBDC's first phase. This first pilot's objective was to establish a test environment that included the proper operation of fundamental CBDC elements such as redemption, distribution, issuance, and payment. Vietnam's state bank to test cryptocurrency use. Pham Minh Chinh, Vietnam's Prime Minister, has directed the country's central bank, the State Bank of Vietnam, to conduct a 2-year trial of cryptocurrency use throughout the country. Additionally, the Prime Minister wants the central bank to engage in the mastery and use of blockchain technology in order to advance the country's economy. The Prime Minister's decision would be welcome news for Vietnamese cryptocurrency dealers, considering there is now no cryptocurrency regulation in place. We hope you enjoyed watching and listening to this video. Please let us know your opinion in the comments area below. If you found our content useful, please like it and share it with your friends. Also, don't forget to subscribe to our channel and hit the notification bell for more crypto-related contents. Will the Bitcoin crash entice more investors to switch to traditional retail investing? The cryptocurrency world is notorious for its extreme volatility, but Bitcoin's plummeting price represents a scale of decline not seen since the market crash of 2018 and COVID-19 uncertainty last year. Will, however, more people cut their losses and return to the relative safety of traditional stocks and shares now that this is the first major fall that many recently arrived retail investors have experienced? It's difficult to pinpoint Bitcoin's recent steep drop. However, the coin's price first fell as Tesla CEO Elon Musk highlighted the environmental damage caused by Bitcoin miners before stating that his vehicle company would no longer accept BTC payments. Following that, the Chinese government published a new set of rules, sending investor confidence and the value of the coin plummeting. The decline in the value of BTC will be especially tough for investors who anticipated that the entry of more institutional investors into the cryptocurrency scene would have built a more firm foundation, preventing the market from experiencing the kinds of volatility that it did previously. As evidenced by the data presented previously, the number of blockchain wallet users worldwide has increased significantly over the last decade, reaching more than 70 million now. With so many new wallet addresses surfacing in recent months and years, long after the major crash of 2018 and the COVID-19 uncertainties that hit the crypto market in early 2020, will Bitcoin's newest crash entice more investors to shift to more traditional retail investing? Volatility is a defining feature. While it may appear reductive to argue that investors were unaware of the volatility for which Bitcoin has become famous, it is possible that many investors, both institutional and retail, were unprepared to see their assets fall by more than 50%. However, according to Bespoke Investment Group, the typical drop from a BTC record high is about 50%, and Bitcoin has fallen down by more than 40% from its record high on 69% of all trading days over the past 10 years. Despite this, more positive investors are advising long-term investors to resist the temptation to sell because of BTC's tendency to rally to new all-time highs in the aftermath of unfavorable downturns. As the data previously indicates, despite the fact that Bitcoin is a much newer asset, it has seen massive price swings when compared to the S&P 500 and gold. The S&P 500 and gold have only experienced a price move of more than 20% in a single day once each. This has already happened 47 times in the case of Bitcoin. The allure of long-term finance. The Bitcoin market isn't the only location where new retail investors have poured in over the last year. Traditional equities have been attracting new investors at an increasing rate in recent years. According to Maxim Mancharoff, head of investment research at Freedom Finance Europe, the COVID-19 pandemic has tapped into a larger investing market of people trying to protect their finances. What we have assessed before appears to be a result of the epidemic and the subsequent stimulus packages, Mancharoff explained. As a result, a pool of funds was created into which regular investors could begin investing in stocks. According to the Fidelity Research, there will be 26 million retail accounts in 2020, up 17% from 2019, with daily trading volume doubling. Despite a significant increase in the amount of investors entering both crypto and traditional stocks, the market is likely to be dominated by the whims of large institutional investors, many of whom have begun withdrawing their BTC holdings in favor of lower volatility alternatives. Surprisingly, institutional investors appear to favor gold's steadiness as a safe haven asset. According to J.P. Morgan, based on open interest in CME Bitcoin futures contracts, significant investors have begun to reverse the current trend of favoring Bitcoin over gold. These large Bitcoin withdrawals are likely to have exacerbated the cryptocurrency's poor performance. The Bitcoin flow picture continues to deteriorate, indicating further retrenchment by institutional investors, according to a J.P. Morgan report to clients. Bitcoin futures markets have seen their steepest and most prolonged selling since the Bitcoin rally began last October. The departure of some of these whales can cause Bitcoin values to plummet, instilling further panic in the minds of smaller retail investors. These soaring figures are likely to sway investors back to traditional investing, yet, in the speculative realm of retail, hints of a Bitcoin recovery will undoubtedly restore trust to the crypto scene. With this in mind, the route of retail investors will most certainly be shaped by Bitcoin's direction in the following weeks. If the bull market isn't over, we'll see May's severe volatility rapidly forgiven and the prospect of faster accumulation. We hope you enjoyed watching and listening to this video. Please let us know your opinion in the comments area below. If you found our content useful, please like it and share it with your friends. Also, don't forget to subscribe to our channel and hit the notification bell for more crypto-related contents. The Central Bank of Vietnam is investigating CBDC. The Central Bank of Vietnam has expressed interest in joining the digital currency frenzy, which does not appear to be abating anytime soon. Numerous financial institutions, international organizations, and government-controlled central banks, to name a few, are examining various options for entering the crypto business. Pham Minh Chinh, Vietnam's Prime Minister, has authorized the central bank to trial a cryptocurrency program in an effort to transition the country to a more digital administration. The program is a critical component of the country's new plan for electronic government. Chinh has directed the state bank to do research into digital currencies and to deploy a blockchain-based currency within 2 years. Pham Minh Chinh issued the order in a proclamation titled Decision No. 942, QDTTG, authorizing the Vietnam e-Government Development Plan to conduct a blockchain and crypto program pilot. The research will concentrate on the application of artificial intelligence, big data, augmented and virtual reality, and blockchain technologies. Notably, the new program is expected to assist the Vietnamese government in determining the risks, challenges, and benefits associated with digital currency adoption prior to embracing digital assets. Additionally, the project is expected to assist the Vietnam Central Bank in building an appropriate digital asset management mechanism. Vietnam's central bank is accelerating the government's digital currency race through a new scheme. According to sources, Vietnam's new central bank program will bolster the country's ambitions in the global race for digital currencies. Hun Ph. Singer, deputy head of the Institute of Innovation at Ho Chi Minh City's University of Economics, said that the Central Bank of Vietnam's recognition of cryptocurrencies would aid the country's transition to a more digital economy. He noted that now is the ideal time for the Hanoi government to do study and trial the use of digital currency, noting that it is an inevitable development. Le Dat Chi, deputy head of the finance faculty at the University of Economics in Ho Chi Minh City, stated that the study should be expedited to enable the government to gain a competitive edge in the worldwide battle for digital currencies. It's worth noting that this latest step demonstrates a shift in the Vietnam Central Bank's stance on digital money. The central bank previously warned that Bitcoin and other cryptocurrencies are not legally recognized in the country. It earlier advised banks and other businesses to refrain from recognizing cryptocurrency as a form of payment. Additionally, a number of central banks throughout the world are also developing programs to create central bank digital currencies, CBDCs, for their citizens. We hope you enjoyed watching and listening to this video. Please let us know your opinion in the comments area below. If you found our content useful, please like it and share it with your friends. Also, don't forget to subscribe to our channel and hit the notification bell for more crypto-related contents. We hope you enjoyed watching and listening to this video. Please let us know your opinion in the comments area below. If you found our content useful, please like it and share it with your friends. Also, don't forget to subscribe to our channel and hit the notification bell for more crypto-related contents.